Today we are going to talk about the market in general. We encountered a few problems on our Zoom meeting, but I decided to create this video right now so I could send it to you guys in your WhatsApp groups, Telegram groups, and all the money team groups. So yeah, and by the way, we are from East Africa, Tanzania. So let's talk about the market right now, about a specific strategy. So what I wanted to teach you guys, first of all, you should understand that this is a free lesson. There are almost 10 lessons with strategies which constitute a general strategy. So I'm going to teach you this first lesson. It's going to be for free, and you guys, you will understand the market on this first lesson. It's actually good. It's going to be for free. If you want to join the second lesson to the 10th lesson so that you can be a good trader, a professional one, then you may just pay for the VIP mentorship. It's not that much. You can pay for it and you can learn all of the strategies. But anyway, this strategy too is important. It's very, very essential. So you guys listen very carefully. Today we're going to talk about the levels of the market. And also you have to consider one thing before we begin. Consider the market as a thing, as something that is attracted to attention. See, we as the sellers, the buyers, and people who put the pending orders and all that shit, and the market makers, everything, we are the attractors. We are the ones that attract the market to a specific or to a certain direction. The market is attracted to the entry points, to the exit points, and to the pending orders and everything. It's attracted to attention in short form. So when the orders, for instance, when the supply area, when the sellers are high, when the sellers are plenty, the market will be attracted to that direction. When the buyers are plenty, then it will be attracted to that direction. See, that is the point of it. When the trade profits are a lot, then the market will be attracted to that specific area. Anyway, guys, what we're going to learn here is something called the momentum and volatility of the market. The momentum situation and the volatility situation of the market. So like I said, consider the market as a thing. Just eradicate everything you know about the market right now and consider this: the momentum, the volatility, and the supply and the demand areas. We're going to learn all that in these 10 specific lessons, but here we're going to have just a single lesson. We're going to learn about the levels in the market. Just and don't put a fixed idea in your mind, like you're waiting for patterns to form. You're waiting for a resistance area. You're waiting for a support area so that you can buy. You are waiting for a pattern, an M or W formation pattern. Don't put that fixed ideology or fixed idea or notion in your mind. Just be dynamic, be critical, think critically, read critically, analyze critically. Just be dynamic in general. Don't be static. Okay, so here is what we're about to learn. The levels that we're going to draw here. First of all, this is the GBP USD, and we're going to consider each and every movement of the market. In order to do so, we are going to use all of the major time frames, all the time frames in general. We're going to use them, except the little time frames, but we're going to use all the time frames. So we're going to start with the monthly time frame. This is the time frame that is used to do the levels. So lesson 1 is the levels, or what we call the zones. This is the lesson 1. How do we draw the zones? We consider 3 things. We consider a correction, or what should I say? We consider a rejection, we consider an impulsive breakout, and we consider a consolidation. See, the market doesn't move in like Newton's law of motion. For example, it just doesn't go in a straight line at a constant speed and in certain whatever or blah 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 blah. The market is like the rain. It has high momentum and low momentum, high volatility and low volatility. It comes on high speed, it reduces the speed. It's just something that is attracted to something. It's attracted to attention, to the news, to the orders, to the sellers, the buyers, and everything that there is to be in the market. It's attracted to every activity. You have to consider that before you begin to draw your zones. Anyway, the 3 situations: the consolidation, the rejection, and the breakout. Those are the 3 things that you have to consider. So you can note them aside and and start looking for them in the market, and you look for these three things in the monthly time frame, and this is the monthly time frame. So what we're going to do here, today is Sunday, so the market has frozen. So what we're going to do here is like trace back the market, trace back into a certain into the past, like few months, years ago. We're going to trace it back, and we're going to draw a vertical line so that we can mark a point which we are going to assume that we are in that specific moment, that current time in that year. So I've drawn this horizontal line to assume that we are here right now in the market in this horizontal line. Just assume that all this hasn't happened yet, and assume that this is what has happened, and we are here now. We are going to analyze this market. Let's do this, guys. See this? Let's assume that this is what has happened, and we are here right now in the market, not here. We are here. So we are going to analyze this market. What are we going to do now? We are going to search for those three areas, and we are going to draw our zones in vertical lines. In horizontal line. This is a vertical line. We're going to draw them in horizontal lines. We're going to draw our zones. And to do that, we're going to consider those three things that I mentioned earlier: the consolidation, the rejection, and the impulsive breakout. Okay, so we are going to consider those, and we're going to search. Let's begin with the consolidation. You have to consider it clearly. The consolidation. Remember, you have to note that more than one candlestick in monthly constitutes to a consolidation. That means from 2 candlesticks and above, that is a consolidation. Consider it as a consolidation. So we're going to search we are going to search a first scenario where there are all three elements: the consolidation, the rejection, and the breakout. So we're going to into scenario number 1, and we're going to search first the consolidation. We can see this. Let me mark this here. Look at this this pointer that I'm using here. See these 2 candlesticks? Any candlesticks are the consolidation. Here's the consolidation. Here's the consolidation. Here's the consolidation. The point is, any consolidation that you choose is okay. So as for us, we are going to choose this consolidation. These 2 candlesticks, we are going to choose them. These 2 monthly candlesticks, we're going to assume that they're consolidations. And once you get your consolidation area, you draw a horizontal line, just like this. You go to your weapons, tools, or whatever they call them, horizontal lines here. So these are the two candlesticks that we consider the consolidation in, and we draw our horizontal line right here. Okay, we have drawn our horizontal line right here. This is the first area of consolidation. So we got our consolidation and we drew the horizontal line. That means in that same line, we are going to look for other elements, the 2 remaining elements, which are the rejection and the impulsive breakout, because we already have the consolidation. Now, where is the rejection? We are searching for the rejection. Where is the impulsive breakout? Okay, look at the pointer. I'm going to show you guys where the rejection is. This is the consolidation, the 2 candlesticks. This is the breakout. This is the monthly candlestick that break this area, and this, my friends, is the rejection. So all the 3 elements are here: the rejection, the breakout, and the consolidation. So see, we got the situation, got all the 3 elements in a single thing, and that's it. So now we're going to search for another area which has these specific traits, these specific behaviors, these 3 elements. We're going to search for 2 areas in order to constitute 2 zones. Though the zones have to be more than 1. So we're going to search for a second possible area. And the second possible area, as we can see, we are searching again for an area that has also consolidated. Okay, so now we look here. What area has consolidated? We go down here. See, this is a consolidation high up here. This one too is a consolidation. So we're going to consider this consolidation right here, guys. We're going to consider this consolidation right here, because we have seen the consolidation. So we're going to draw this. We're going to draw this consolidation. Let's draw it quickly. This is the horizontal line, and this is the consolidation area. See, we have drawn our consolidation area like this. Let's do it like this. Okay, so after marking the consolidation area, now we search where is the breakout and where is the rejection. Here is, look at the point, here is the rejection, this is the consolidative area, this is the breakout, this candlestick, and this is the rejection. See, this one, this candlestick, this bullish candlestick is the damn rejection that happened right here. Okay, so we already have two areas, two zones, two levels. We already have two levels. So these are the monthly levels that I was talking about. We already drew them. So what we're gonna do next here is there is something, we're going to put the lines clearly. So there is something that you have to consider too. There are these, what they call institutional numbers. They call them the institutional or psychological numbers. See, the market moves in psychological pattern. Those institutional guys, they move the market in psychological pattern, and also in the mind of the people, just psychologically, people usually do approximations. Like I said, the market is something that is attracted to attention. It's attracted to the orders of the people, the pending orders, the sellers, the buyers, and everything. And what do the people do? You think about that. What do the people do when they put the orders? They when you put your take profit, or just think of you yourself individually, what do you do when you put your take profit or your stop loss? You usually do the general number. You generalize the numbers. Like for instance, if the take profit is 1.41333, you just say, okay, I'm going to put 1.410000. See what I'm trying to tell you guys? Consider the general numbers. The market is attracted to attention. We are the magnet that attract the market. We are the people that attract the market. Now, what do the people do? The main attractors, the magnets, what do they do? What do we do, the people? What do the institutional guys do? Because they are also the people. What do? We usually do the approximations. We put in the stop losses and put in the take profits. We approximate stuff. That is why the point of attraction of the market is usually, no matter what the time frame is usually the general numbers. It's the general numbers. In short form, just consider it as an even numbers, because all of us, like worldwide, seriously, like worldwide, we all like even numbers. You know, we choose even numbers from the odd numbers. We like the general numbers that are divided by 2, or the numbers that are just general in nature, like 500, 200, 100, 150, 450, 250. See, you see what I'm trying to say? You can't put 253 or 251 or 513, but you can put 510, 250, see, 250. You can just do that. So the general numbers are the even numbers. You can just put it that way. Numbers that are divided by 2, those are the general numbers, because the mindset of a human, we as the traders, we usually generalize the numbers and do the even numbers. When we put our take profits, we just generalize. We put the number that is general in nature. So this is what the market is doing. Its turning points will be the numbers that are general in nature, the parameters that are general, the numbers that are general. So we searched our area. Now we're back to the market. Now we searched our area that has all the 3 elements: the consolidation, the breakout, and the impulsive, the breakout, and the what, and the rejection. We already put in the horizontal lines here. So what are we going to do in these horizontal lines? We are going to generalize the numbers. See, we put on the horizontal lines. Now we're going to generalize the numbers. We're going to search for the general parameters. Now we take one horizontal line and we go to properties and generalize this number. See, this is 1.33633. What does a normal human mind do? They generalize. We generalize our take profits. So this is what we're going to do here. We are going to generalize this number 1.33633. What will we do here? We are going to approximate this number into an even number. That means approximation will be 1.33700. There, done. And we're going to generalize the other one too. All of the 2 lines, we generalize them. Oh, sorry, it was, let me go back first. Okay, we're going to generalize this. See, it's 1.41976. Generalization here will be 1.42, because it's 972. It's only a few digits left to 2000. to what, at 1000. So when we approximate here, it will be like 2000, just like this, guys, like this. So this is the approximations, this is the even number, this is the psychological number. What we do in the market, our approximations, the little things that we do are the ones that affect the market, that make the market be attracted to that certain situation. So you have to know that it's the little things that matter. It's the little things that rip the market apart. It's the little things that rip you apart, takes your stop losses, takes your profits. It's the little things that matter. Every approximation, every move that you do in the market, everything that you do is very well considered by the market itself. So these are the even numbers. This is how we have approximated, and this is how we got our levels, our monthly levels. I hope everyone is intact, everyone's mind is intact. This is how we got a monthly level. Now what we're gonna do after this is we are going to equalize. We are going this monthly level, the distance from this line, this monthly level to this monthly level. We are going to put other monthly levels with the very same distance. For instance, we are going to calculate the distance between, let me put a pointer. We are going to calculate the distance between this monthly level to this monthly level, and we are going to put that very same distance above this monthly level, below this monthly level, below this monthly level, because that's what we're gonna do. We are just going to input this distance to another one, so you can get a third monthly level, and we're going to input this distance again to another one, so you can get the fourth monthly level. That's what we're gonna do. You just search for the two market levels, the monthly levels. Then those monthly levels, you duplicate them. You duplicate them to the upside and to the downside. You create other monthly levels. So that's what we're going to do right now, and we're going to calculate. So this video will be kind of long, but it's very essential. We are going to calculate the distance, the pips. Okay, so now we continue. These are the monthly levels. Now it's time to duplicate them to duplicate them bearish and to duplicate them bullish. We're going to put them right here. First, we're going to calculate the distance. The distance are going to be calculated by these parameters of the levels that we have drawn, the two areas that we have drawn. The first area, this one, this upper area is 1.42000, and this is 1.33700. We are going to calculate the distance, and then we are going to put in the areas. Okay, I'm going to do this real quick by using okay, so this is what we are doing right now. You minus this number 4200, the parameters of the first zone, and then you minus, this is 42,000. You minus with 3,300 and 33,700. So here you'll get, you know what? Let's do this. We're going to do this real quick. Okay, 42,000 minus 3 minus 33,700. 33,700. Be very careful here, guys. Be very keen. So our distance that we got, the distance between one monthly level to the second monthly level, is 8,300. You can save this. You can save it in your notebook. 8,300. This is the distance. Now, this is the distance. Now we're going back to our charts. See, this is the actual chart. This is the distance, and this is the chart. This is the chart. So this is the distance, and this is the chart. So if the distance is 8,300, 8,300, meaning we in order to duplicate it into the bullish areas to create another monthly level, we are going to add with the existing monthly level. We're going to add the distance with the existing monthly level. In order to duplicate it below, we are going to subtract with the existing monthly level. Now we are going to search the one that is above. That means we'll take 1,000. Okay, watch here. 1,000. We'll take 4,200. The high this is the parameter of the high monthly level, the one that is the upper one. We are going to add it. It's 1.42,000. We're going to add it with the distance. The distance is 8,300. We do this plus the distance, 8,300. This is the distance, is 50,300. This is the parameter of another. This is the parameter of another monthly level. So we're going to put into objects here. We're going to draw the other monthly level, and we're going to put that parameters 3,000. We're going to put that parameters. It's 5,000. See, it's 5,300. Done. This is another monthly level. Now we're going to search a monthly level that is below. That means we take this lower monthly level and we divide it with the existing distance, with the distance in between. That means it's one, this lower monthly level, this one that I'm talking about, its parameters, it's 1.33,700. That means 1.33,700. Take 33,700. We subtract with sorry, it's not minus. We subtract with the distance, which is 8,300. This is the distance. So the distance is 25,400. That is the parameter of. That will be the parameter of another monthly level. We're going to edit this parameter here. It's 25,400. 25,400. This is the other monthly level. Now we're going to take this distance, this 25,400. We're going to subtract it again with the distance in between. Again, the distance in between. We got 17,100. 17,100. That is the parameter. That is the parameter of another monthly level. 17,100. See, this is it, easy. So remember, I put this vertical line just to consider that we are in this point in the market. We're in this area in the market. Our current position is this one. Don't consider these ones. We just consider this one. This is our current position. This is the area that we considered. This is the first area that we considered, and this one is the second area that we considered. Sorry, this is the second area that we considered, this one. That means we're in this point in the market. We're in this area in the market. These are the monthly levels. I hope you have all understood how to do the monthly level. You just do the parameter thing. You just take the first monthly level and the second monthly level by considering the three elements: the consolidation, the retracement, and the impulsive breakout. Then the distance in between them will be duplicated high above, and they will be duplicated below to create other monthly level. The distance has to be the same. That means these are the monthly level. Now what we have to do again here is draw the weekly level. There are three kinds of levels that we're going to draw here: the monthly, the weekly, and the daily. That means we're going to draw the weekly. In order to find the weekly level, we are going to put the distance between the monthly level is the weekly level. That means the weekly level, we're going to put the horizontal line in between the monthly level and in between the distances of the monthly level. How do we find the exact parameters of the half an area of the monthly level? We take the distance, we take the actual distance, in between, and we divide it by 2. We divide it by 2. That means our actual distance was 8,300. Then we divide it by 2. This is half the distance. This is half the distance. Remember, we are searching for weekly. The monthly is done. Now we are searching for weekly level. This is half the distance, 4,150. That means this distance, in order to calculate this distance, we are going to use each area, and we are going to subtract it with the half the distance. We're going to subtract it with 4,150. So we're going to do this real quick right now. I hope you understood. So we're taking this above area, this 1.5300, 1.5300. We're subtracting it by 4,150. We got 46,150. This is the parameter of the weekly, 46,150. 46,150. See, this is the weekly. This is the weekly area. We're going to use the blue lines for weekly. This red is monthly, the blue is the weekly. Remember, the in between space is the weekly zone. Now we are going to take this monthly level. We are going to subtract with 4,150 again. The parameters are 42,000. I mean 42,000. We are going to subtract it with 400 and 150. We got 37,850. So we're going to put in the parameters here, 37,850, like this. Done. And now we're going to take this below and subtract it again with the half the distance, 33,700. 33,700 minus 4150. We get 29,550. 29,550. Done. And we take this monthly level to 1.25400. So we take 25400. We subtract with 4150. We get 21,250. Yeah, so we got 21,250. They have the distance, 21,250. 21,250. Okay, so this is it, guys. 21,250, and we're putting in the last one. It's 1.17100. 1.7,100 minus 4,150. Got 129.50. 129.50. This is the parameter. 129.50. Okay, so done. So these are the weekly levels. The blue lines are the weekly level, and these ones are the monthly level. Remember, the monthly level are the ones that we consider the element, the consolidation, reversement, and the breakout. And then we duplicate them. After duplicating them, then we use the half the distance. The in between area is the weekly level. That means the in between area is the weekly level. Now we're going to search for the daily level real quick. We're going to search them. Now remember, the calculation is the same. I mean, this video may take a very long while, but the calculation is the same. Now the daily level will be as this. You calculate the space in between the weekly and the monthly. That is the daily level. Now calculating the space between the weekly and the monthly, meaning we subtract. You just take the monthly, you subtract with the weekly, and you get the daily level. That means in here we take 1,400. We take 1,000. We take 42,000 minus. In here we do this 42,000. We subtract with not minus. We subtract with the weekly, which is 37,850. 37,850. It's 4,150. It's 4,150. It's 4,150. So we do this 4,150. We're going to use the golden line, gold, as the daily. 4,150. So the gold is equal to the red. We are going to use the blue line as the daily. 4. Let me search for another color. Okay, let's use the black. The black one. Okay, so we take this distance in between, this space in between. You take 1.42,000. You subtract is 1.37850. The space in between is the daily level. I'm just going to skip the calculation because the video will take long. So we're just going to approximate the distance in between. We're going to approximate like this. See, the daily is indicated by the black line. These are the daily levels. These are the daily levels. Calculation, just take the monthly minus the weekly. The space in between monthly and weekly is the daily level. Easy. Space in between monthly and weekly is the daily level. And the weekly level is the space in between the monthly levels is the weekly level. Okay, so this is it, guys. We are done with the levels. This is it. The levels are done here. So remember, I said that we consider the market, we consider the situation of the market, that we're in this current position, that we are here right now. Meaning whatever happens after here is because of the levels that we have drawn. The market will respect these levels, and it will make the turning points towards these levels with even numbers, the general numbers. So that is what will happen right now. So let me slowly slide it and see what the market will do. See, this vertical line, this one, this is where we analyze the market, this one and backwards. That means whatever happened from here to the front side is a result of the levels that we have drawn. I mean, the levels show us what to do in the market. So you see, this is what happened. This is what happened, guys. This is what happened. Look at the indicator. So here, our analysis ended here, and the market started to go. It continued to go. This is what happened. You see, it reached the daily level, it rejected 3 times, and then it went high up, it went above, and then it made a turning point. It made a turning point to another weekly, to a weekly level, and then it went down. It made a turning point to a daily level, it went up. It made a turning point to a weekly level, then to a daily level here, it went up. See, it's making turning points on the levels. That's easy. It's just making turning points on the levels. That means when you know how to draw these levels, it will be easier for you to spot the situation of the market, and for you to put on the entries. I mean, to search for the entries and to know what you are doing in the market. These levels are respected. That means after drawing these, the market will just follow the areas. See, for instance, here until here, and you get like a lot of pips, guys. You get like a lot of pips. You can even switch to smaller time frames like the daily, to other time frames like the daily. See how the market respects the levels. This is the area that we calculated. Now see what it did here on the daily. It went on this level and it went up. If someone sold here, take profits on the other levels. See the take profits. It's respecting the levels. It went up again, it went down. This is how the market is going. It's respecting the levels. See, you get very nice entries. You just have to risk well, and you do the orders, you trade. See this area up, it respects the levels. Anyway, we are done with our lesson here. This is lesson number 1, the levels. There are 10 lessons, and the other lessons are more about the entries. They are more about the entries, the price action, the better price action. It's about the demand and supply areas. It's about how and when to know when to enter the market, to know when you're going to enter the market, how to trade, the stop losses, the take profits. You are going to be told everything on the next lessons. We have 10 lessons. This is lesson number 1. It's the levels. We also have other lessons, the supply and demand areas, the momentum and the volatility, the smaller time frames, how to catch the trades, how to do everything. So in order to keep up with the lessons, you can pay for the VIP mentorship. I'm going to send in the details right now for the VIP mentorship, so you can keep on with the lessons. And promise you, when you finish all of the 10 lessons, you will be a competent trader. You will just have consistency. You just risk well and get your orders and to get your money. So this is it, guys. I think we are done here. Details will be sent on the mentorship. Those who are already on mentorship, you can just go there. We continue the lessons there.